Right, so today's session is going to be on risk. This is, for me, one of the most important, if not the most important aspect of trading. If you can learn how to manage your risk properly and responsibly, you will always be in control of your account. It's the one thing, basically, and to be a successful trader, it's certainly in the long term, you have to learn how to manage your risk properly. There is not a single trader, not a single successful trader that doesn't know how to manage their risk appropriately and responsibly. It is the one fundamental thing that separates the successful traders apart. So it's really important to get a grasp on this straight away. There are some out there who promote irresponsible risk management, some that don't even really teach it. But like I say, for me, it's one of the most important aspects, and it's really one of the things that I base all my sort of education and teachings and everything around. So we're going to go through a variety of different things in the session. We're going to talk about what risk is. We'll talk about what risk to reward is. We will also give you an outline on how the amount you risk per trade should vary depending on your style of trading, your frequency of trading, and what that sort of should look like as well. Give some guidelines around what you should be risking on each individual trade depending on your style of trading. Again, hopefully the session will aim to be about sort of like 40 to 45 minutes long, giving that sort of 15-20 minutes at the end for any questions that you have. So yeah, with that, let's get on into the session. If I can just do one final quick sound check, if somebody can just let me know that you can hear me and you can see my screen, that would be great. Just double checking. I can see my volumes bar is changing, so I'm guessing it all good. Perfect. Thank you very much, Catherine. Good to see you here again as well. Right. Okay. So let's get on with the session. Quick disclaimer, obviously, I won't read through it all, but you need to be aware of the risks involved with CFDs as well. So I'll leave this up there for a moment for you to just read through. Right, cool. So let's get on with the main part of the session. Obviously, as I say, any questions that come up, please feel free to post them into the chat box or into the questions box. If it's distinctly relevant to that point, then I will answer it then. If not, we'll try and keep the presentation flowing and I'll come back and answer it at the end. So please don't think that I've ignored the question. It's just maybe I will come back to it at the end of once the presentation is completed as well. So, right, as I've just said in this sort of like in the introduction, risk, in my honest opinion, is the most important aspect of being a long-term, consistently profitable and successful trader. Without the correct risk controls, you run the risk of blowing up your account. And if that happens, you cease to be a trader. And along with that, all the opportunities that trading brings fade away and cease to be open to you. So if you lose all the money and all the capital that you have open to your trading account, you cannot trade, you cannot make money, and therefore you don't have the opportunities available to you anymore that trading can offer. So most courses, most trading education companies will focus on marketing their profits. They show their clients making multiple percentage returns on a single trade. I'm sure you've all seen this on social media, on Instagram. You know, this client has got out the 9 to 5 and is now making £10,000 a week, or you know, this client of mine made 16% returns on one individual trade. In my opinion, it's irresponsible, as they don't actually show several things. They don't show what the client had risked to make those returns, and or they don't show the potential losses they would have made had the trade lost. I've seen it several times whereby, you know, somebody promotes that their client made 10, 15, 20%, on a trade, when I sort of like look at the parameters of the trade, they risk like 30 or 40% of their account to on that one trade. So if you lose that one trade, you lose 30-40% of your account. So it's completely irresponsible. They don't give the grander sort of bigger picture around that sort of like that scenario. And also, it's one individual trade. It doesn't show the losses that lead up to that trade. It doesn't show the drawdown. It doesn't show the bigger picture in terms of that strategy and the overall risk that that individual is taking on in the markets at any one particular time. So as a trader, we need to be risk focused and not profit focused. Again, most people will look at the money that they can make rather than the money they can lose. If we focus on the risk, we're always aware of the amount of money that we can lose on any one individual trade. We accept that emotionally, and therefore when it happens, because it happens regularly in trading, we are much more at ease with it. So being risk focused and managing the risk, then actually the profits end up taking care of themselves, and overall the edge will work. And by being risk focused, it can actually help with our emotions, because we are focused on the bit that causes a lot of the emotional issues in trading, and we can emotionally accept them as well. Your career as a trader will ultimately be defined by how you manage your risk. And this is in both in a good and bad way. If you manage your risk extremely well and you learn risk management techniques and you manage your risk responsibly, your career as a trader will be defined by that. You will always be in trading for the long term, and I'm going to go through how a bit later on how and show that if you can learn how to manage your risk, it is basically virtually impossible to lose all of your capital. That said, your trading career can be defined by one individual trade. If you don't know how to manage your risk, I've seen this several times, your career can be defined by a single trade, whereby you haven't managed your risk appropriately, you have taken on too much risk on any one individual trade, and you blow up your account based on one trade. One trade should never define your career as a trader, but unfortunately for some it does. As we mentioned, drawdowns are inevitable in trading, and when they occur, they are completely random. We don't know when those drawdowns are going to happen. If we did, we could avoid them, but drawdowns are just a natural part of trading, and they are completely random, which is why we need to risk sensible amount at all times so that our account is protected at all times. Don't leave anything to chance. Don't leave anything to random distribution. We need to be consistent, and we need to be prudent at all times and risk appropriately and sensibly at all times. We should also calculate our risk determined as a percentage of the size of our account, as that allows us to manage the trade appropriately. It also now allows us to manage our account as it grows much better as well. Again, from an emotional standpoint, if we're always risking 1% of our account, we're always risking 1% of our account, whether that's risking £10 on a £1,000 account, or risking £100 on a £10,000 account, or risking £10,000 on a £1 million account. You're only risking 1%. Yes, the monetary value, the nominal value is vastly different, but the actual, if we think of it in terms of percentages, again, it's very consistent. We don't have to, and if we can get into that mindset, again, it will help us emotionally as our account grows, because it's always going to be the same. It's just 1% of our account. If we compound and keep it relative to the current account size, then we not only help grow our accounts quicker as we profit from trades, we also protect it against drawdowns. And again, I'm going to show this in an example in a little bit, whereby if you compounding is not just compounding on the way up to make exponential gains, it's also compounding on the way down to protect our capital as well. So if we go through drawdown periods, we can actually reduce our leverage. It's still only 1% per trade or 0.5% per trade, whatever your risk is, but it will always remain consistent, and therefore it protects your account on the downside, as well as helping you grow your account exponentially on the upside. Okay, so the amount that you're going to risk on each strategy should be detailed in your trade plan. We're going to just cover how to create a trade plan later in the course. And the reason for this is to leave no room for ambiguity. There's no room for emotions. There's no room for you to sit there and see a setup and go, oh, I really like this one, I'm going to risk a little bit more, or I'm in a run of losers, so I'm going to risk a little bit less on this one. If it's in your trade plan, it's stated in your trade plan, that is what you risk, that is what it builds into a subconscious habit, and therefore you stay consistent, which is why it's really important that you have it detailed in your trade plan so that you leave yourself less room for ambiguity in those trading decisions. We should not have to think about our risk when we're entering a trade. It should be defined and in our subconscious, which is why I just said why it should be in our trading plans as well. Choosing your risk amount on each individual trade will depend on many factors, which will include your frequency of trading, the probability of the win rate of your strategy, and the risk to reward ratio of your strategy to make sure that it has an edge. Ultimately, we should always be thinking about the worst case scenario and how that may impact us. So we should be thinking about what the worst case drawdown period is and how that will impact us emotionally and how that could affect our decision making. If we are risking 4%, 5% per trade, and there is the potential to lose 10 trades in a row, you're effectively looking at potentially losing 40 to 50% of your account, which emotionally is very difficult. And also, if you think about it, at 40 to 50% of your account down, you need to make 100% returns to get yourself back to break even. If you have a £10,000 account and you lose 50%, you're at £5,000. You then need to make another £5,000, which is 100% of your current account, to get back to just to break even. So we need to think about worst case scenario and how that can affect us. If we take the same scenario and we are only risking 1% per trade, we are down to 90%. We've only lost 10% of our capital, and we only need to make 11.1% returns to get ourselves on that current account balance to get it back to break even. So we need to think about the worst case scenario and how that can impact us emotionally and how that will have impact our decision making. I personally recommend risking somewhere between 0.25% and 1% per trade as a day trader, and again, that will depend on your frequency of trading. This is not a fixed rule, it's just used as a guideline, but to work out how much you should be risking, calculate the average number of trades that you take per month and think that if they all lost, what would the loss on your account be? So, for example, if the scenario occurs, you should not exceed 20% of your account. So as I say, as an example, if you trade 20 times a month, you can risk 1% per trade. So if every single trade lost, which is a very highly improbable situation, even from just a statistical point of view, you can risk 1% per trade. So that if all 20 trades lose, you would lose 20% of your account. Obviously, even if you have a terrible month and you're going for a one-to-one risk reward strategy and you only win 5 trades, and you're still only down 10% on the month because you've had 15 losses, 5 wins, so you're down 10%. Equally, say you're going for a 3-to-1 risk to reward and you only win 3 trades, so it's a 15% win rate, so a really bad month on that sense. You make 9% from your wins, you lose 17%, so you're only down 8%. So yes, it's not an ideal scenario, but just by having that sort of number in mind, from a statistical point of view, you should always have a reasonable amount or an acceptable amount of drawdown. If you average 10 trades a month or less, and you have enough experience, and I have to stress this, that you shouldn't do this until you've built up the correct experience, demonstrated that you can perform the correct processes and have solid risk management strategies in place, then maybe I would say up to a maximum of 2% risk per trade is acceptable, because again, it's keeping that within that 20% parameters. But equally, you've demonstrated, but you need to demonstrate you've got the emotional intelligence to follow those processes and have the experience to be able to risk that amount per trade as well. Anything over 10 trades per month, and I would really advise 1% or less on any one individual trade. So as I mentioned, the frequency of trades you will take will have an impact on the amount you should be risking per trade. So if you're a scalper or a high frequency day trader who can trade several times in a session, then you will want to be looking to trade 0.25 to 0.5% per trade, maybe even as low as 0.1% per trade, depending on the frequency. think about it this way: if you're trading 1% and you're risking and you're trading 5 times a day, you know, you're risking 5% of your account every single day, which in my opinion is a little bit too much to take emotion. Because if you're just off it for like a week, if you're just emotionally not at it for a week, it can have a real knock-on effect and a real impact on your account. So by reducing your leverage and your risk per trade when you're high frequency, then it sort of manages that as well. So, and as I say, if you're trading sort of 10, 15, 20 times per day, you may be even as low as 0.1% or maybe even less of your account each individual trade. As a day trader, which is a trader that trades in most sessions, but maybe not every session, you would be looking to trade 0.5 to 1% per trade. And this is the category that I sort of style myself on and my trading on. I'm in this sort of 0.5 to 1% per trade category. If you're an intraday or day swing trading, this is sort of like trading off 1 to 4 hour time frame charts. You probably will be looking at around that sort of 15 to 20 trades per month, in which case you'll be looking at that 1% per trade as well. Swing position trading, which is a low frequency trader who should be risking 1% per trade. If you trade less than 10 times per month on this sort of style of trading and have demonstrated consistency in performance and execution, as I mentioned, that is really important and to stress, then I would recommend a maximum of 2% can be a responsible amount to risk on any one individual trade. Okay, so that's sort of like just an outline of risk and hopefully a guideline of what we should be risking to make it responsible, and how we can sort of like, hopefully you can see that by risking those amounts, it helps protect our account at all times. So we're now going to move on to risk to reward. Now, I'm not sure if anyone knows, if anyone is unaware of what risk to reward is, but risk to reward is something that you must know when you're in trading, because it's what determines one of the big factors in what determines whether your strategy has an edge. And what risk to reward is the ratio between what you risk on a trade and what you can actually make on a trade if it hits your profit target. So for example, if you risk 1% of your account with a 50-point stop and you target 100 points, you would make 2% returns on your original account balance. Or simply put, you would make 2 times as much as you risk. You would make 2%. So therefore, as an example, the risk to reward would be 1 to 2, because you risk 1 to make 2 times the amount of your reward. There are a variety of factors that can affect your risk to reward ratio. Now, the lower your risk to reward, I'm going to just abbreviate this to RR. The lower your risk reward, the higher the hit rate you would need from your trade plan to achieve profitability. So if you have a 1-to-1 risk to reward or lower, you need to have let's take this as an example. For a 1-to-1 risk to reward, you need to have a 60% hit rate for that trade to be profitable, before that edge to be profitable, so that you make more money from your wins than you do from your losses. If you have a 3-to-1 profit ratio, risk reward ratio, if your hit rate is only 40%, actually you're going to be much more profitable and you're going to make a lot more money. So your hit rate needs to be lower when you have higher risk to reward ratios, and you need a higher hit rate in terms of higher success rate of the trades hitting your profit target when you have lower risk to rewards. So some people like to go for high risk to reward ratios, as it means they can accept a smaller hit rate. They don't have to win as many trades for them to be profitable. Others like to go for smaller risk to reward ratios, as their hit rate should be higher, and that helps them very much emotionally deal with if they find it hard to accept losses or hard to accept drawdown periods. They will need to go for smaller risk to reward ratios. There is no right or wrong, and I'm going to get into this in literally just a second, but the ultimate aim is to create a style of trading that suits your own profile, your own trader personality, and that makes you money. That's the most important thing. We need to make you money. Risk to reward is often quoted with your reward first and your risk last. So for example, if I sit there and say, oh, I've got a 2-to-1 risk to reward on that, I'm generally speaking that I've made twice as much if the trade hits my target as I would lose if the trade hits my stop. So it's a little bit just of an oxymoron in terms of, you know, it's pronounced risk to reward, but generally speaking, if you say your risk to reward is 2, you've got a positive expectancy, so therefore it's like a 2-to-1 risk to reward, reward to risk. Right, I hope that all makes sense. Now, I've seen this all over the internet. I've heard it so many times from various different traders and educators. Some traders will tell you that you cannot be a successful trader unless you have at least a 2-to-1 risk to reward. Others will tell you that you need to aim for low risk to reward trades, as you cannot be successful for going for what they determine home runs, as in like those big sort of knock it out of the park winners. The truth is, you can, they cannot. They are talking about their own personal experience. So those that say that you cannot be a successful trader unless you have at least 2-to-1 risk to reward, they probably struggle emotionally with sort of like a FOMO, where they're trying to, even when the market reaches their profit targets of like a 1-to-1 risk to reward, they're trying to run trades and trying to get that little bit extra out of the market, even though their strategy says they shouldn't. And therefore they cannot emotionally deal with only going for 1-to-1 risk to rewards. The ones that tell you that you need to aim for low risk to reward trades because you cannot be successful going for home runs probably cannot deal emotionally with going through larger drawdown periods or longer drawdown periods, probably don't know how to manage their risk in that sort of sense. So people that sit there and say that to you, they're only talking about their own personal experience, not the actual bigger thing. I've met many traders from different types of trading as well, who go for different risk to reward ratios, who are all successful. So it's about the individual. It's not like a generic thing. So as a coach, it is vitally important to not impose my own style on anyone in particular individual. We're all unique, and we have to identify what works for us as an individual. I have coached traders who are mechanical and set and forget traders, systematic traders. I have coached people who are highly frequent traders. Now, neither of those trading styles work for me, but I've managed to work with them to make them successful, because I don't look to impose my own style on them. I work with them to work out what their personality is. I work out on their strategy, and I work out on what their emotional issues are, and guide them in terms of what is the best style of trading for them. Now, the one thing that all successful traders have in common, and this is why I think this is the most important aspect of trading, is that they learn how to responsibly manage their risk dependent on their style of trading. And that's how, as a coach, even if they have a different trading style to me, I can still help them become profitable, because I help them focus on their mindset, their emotional. I find out, help them work out their identity, to work out what style of trading they is best suited for them, and then I help them learn to manage their risk, and that helps create them profitability. One guy, he trades much more frequently than I do. He trades multiple times a day. When I started working with him, he was trading like a couple of hundred times a month. And he had issues mainly around purely not being able to manage his risk. He'd be profitable for a couple of months, and then he'll blow it all in like a single trade. So we worked with him. He still trades much more frequently than me, but we've got him managing his risk, and he now has been profitable for like 3 or 4 years. So again, it just shows that there's no, and he goes for probably a less than 1-to-1 risk to reward ratio. So it just goes to show that, it's not, anyone that tells you that it's about risk to reward is talking about their individual experience. You've just got to work out your own personality, your own profile, and then learn how to manage your risk in appropriate way to find to that style of trading, and then you are more likely to be successful in the long run. Okay, so I'm going to talk about now as a risk management technique that I use and I teach with my students, and it's scaling out of our trades. So scaling out of our trades, and I'm going to talk about a bit more about how we do this, allows us to reduce our risk exposure on a trade. So again, once we're in the trade, so we defined out the risk at the start of the trade, but once we're into the trade, we should be looking to manage our risk as well. So by scaling out, it reduces our risk exposure within the trade. Potentially, we can even make a trade risk-free to help reduce our emotions in our trading. it can turn losing trades into break-even trades, or at least losing trades into much smaller losses. And say for example, you risk 1%, it can mean by scaling out, you can actually reduce the loss to like 0.5%, 1/3%, or even less. And by doing this, it also helps reduce variance on our account. And I'm going to talk about variance a little bit more. I think it's next week, and what this means. So, for example, if we close 50% of our position, so say we open a position with 2 lots, we close 1 lot of our position, we can move our stop to a point that our trade is risk-free. So if we're going for a 3-to-1 risk to reward, and we close half of our position, so we close 1 lot at when we get to 1-to-1 risk to reward, well, what that basically means is we've made 0.5% on that first part of the trade. If the trade now goes back and hits our stop, we will lose 0.5% on that trade as well. Therefore, we are actually risk-free. That second part of the trade can now go risk-free. If it goes and hits a 3-to-1 target, brilliant. We make profit. If it goes back and hits our stop, it doesn't actually matter too much because we're not even going to lose money then anyway. So if you struggle to accept a loss, or you allow a trade to run, or you struggle to allow a trade to run to its full target, then what you're doing is you're allowing emotions to dictate your trading decisions, and scaling out is a great way of mitigating and reducing the impact of the emotions on your trading decisions. So even reducing your exposure by booking 25 to 33% of your profits, you can drastically reduce the amount of risk on the trade if the trade eventually went to hit your stop. So again, taking it back to that example from a second ago, if we close 1/3 of our position at 1-to-1 risk to reward, and then it goes back and hits our full stop, then we lose 2/3% on the second part. We've made 1/3% profit. So actually, from an original risk of 1%, we've now only lost 1/3%. So it's just managing our risk, and a way of managing our risk within the trade as well. So it's a good idea to scale out of trades in the following scenarios. Obviously, if you struggle emotionally, if there is an area of support resistance that may cause a reaction between your entry and target, including dynamic support and resistance like moving averages. Obviously, if you're taking a trade directly, if there's support resistance directly at your entry, you shouldn't really be taking a trade anyway. But if there is a potential area of support resistance or minor support resistance between a target and an entry when you're going for those higher risk rewards, that's a good point to scale out. Definitely, if you're trading against the overall trend, you want to be managing your trades aggressively. So it's good to scale out and make trades risk-free when you're trading against the overall trend. And if you can pay for a stop in a suitable place that the market should not revisit, if the trade idea is to remain valid, i.e. you get through an area of support or resistance, and you close out to pay for a stop below that area, that's also another valid way. So Ian's asking, to scale out, would you have to enter a number of small identical trades? On some platforms you do, yes. So certainly on MT4, well, you can close them out manually, but if you want it to just to set the trades and then it just to do it automatically, then yes, you would have to set a small number of identical trades. If you are happy to set an alert, or you're going to be around at the screen to manage it, then you can set an alert and you can come back and you can actually individually close portions of the trade. Certainly if you're going to hold positions overnight and stuff like that, then yes, because you're not going to be around to be able to manage it. If it hits certain levels, then yes, you would need to enter a number of small identical trades. But depends on your style of trading. Intraday, if I'm generally going to be around at the screen, I can manage it. I can just set my alerts and I don't need to input individual portions of the trade. So one way that I recommend to see whether scaling out is having a positive impact on your profit and loss, you should keep a record in your trading journals. I'm going to again demonstrate how to complete a trading journal and hopefully provide you with a template of a trading journal, and it helps us identify how scaling out as a management technique affects our P&L. It will enable us to analyze and see if we're scaling out too early and if it is having a positive impact on our trading. Now, I've come across many people that are skeptical about scaling out as it has an impact on your risk to reward, which is very true in a two-dimensional way. But again, this is a profit-focused approach rather than a risk-focused approach. If we look at it with a bigger context, we can see it can be positive. So again, say we're going for a 2-to-1 risk to reward and we scale out at 1-to-1, well then actually our profit potential becomes 1.5 times what we originally risked. So yes, it does have an impact on our overall potential profitability. But even though it can reduce that profit potential, it will also remove and reduce potential losses. So our realized risk to reward will generally improve. So as I say, some trades that would actually go to a full loss, if you scale out, they become break-even trades. So rather than taking a full loss, you're actually not making anything, but you're not losing anything either. So it can offset that as well. I'm going to go through an example in a second, a very generic example to illustrate that. As long as we keep a record of how it affects our trading in our journals, we can then remain dynamic as to how we use scaling out to make sure it has a positive impact on our trading. We can use it to work out whether it is actually improving our trading, whether it's having a detrimental effect to our trading, and whether it's whether we're scaling out too early. Some people may even, and I actually did this when I was very early on in my trading career as an individual. I accepted a slightly smaller return in exchange for less variance on the account, as it reduces the impact of the emotions in their trading and on their trading decisions. So say, for example, a trading strategy has an edge of 20% over 100 trades, but has a fairly larger drawdown period. That larger drawdown period may impact your decision making and actually end up meaning that you can't realize that 20%. So by being able to accept, say, 18% returns over the same sample, data sample, but being able to perform individually to that 18%, you can accept that little bit less because your emotions may not allow you to perform at the and make the decisions that are necessary to create that sort of like a slightly more profit potential over a long period of time, because you can't accept the emotional issues that come with drawdown periods. So as I say, I'm a lot better at it now because I have much better idea on how to manage my emotions. But when I first started out, there were some strategies where I worked out that my actual individual performance was not as good going for those slightly higher returns. So I accepted slightly lower returns but less variance on my account. By scaling out, it can also allow us to run profits further when we are with trend safe in the knowledge that we cannot lose on the trade. We can also continue to scale out to book in more profits along the way. So for example, again, if we're going for a 3-to-1 risk to reward, we can scale out a third at 1-to-1 risk to reward, a third at 2-to-1 risk to reward, third at 3-to-1 risk to reward, booking in profits, reducing risk along the way, and going for those bigger targets. We should look at scaling out as an insurance policy against our account. Basically, it's protecting our account, it's managing our risk, which again is never going to be a bad thing. So now we're going to run through a quick maths example just to illustrate this as well. It's not a real life example, but it just shows hopefully that this can happen. And I've done this in back testing where I've back tested certain scaling out techniques, and it does play out in some strategies, not all strategies, but some strategies. This does actually play out in real time as well. So let's say, for example, we take 6 trades at 1% risk to reward, at 1% risk per trade and 1-to-1 risk to reward. 5 trades win and 1 loses, all at full stakes, without risk management, without scaling out. We'd make 5% from the 5 trades that win, would lose 1% from the trade that losses, so we'd be up 4% overall. Now let's say, for example, in our trade plans, we take 50% of our profits when we get to 70% of our way to our profit target. This would mean that we make 0.35% on the first half of the trade, because closing out half of that at 70%, and we make 0.5% on the second half of the trade that we let run to the full target. So we make 0.85% overall, or 0.85 to 1 risk to reward, which again is a negative risk to reward. It's a less than 1-to-1 risk to reward, less than we started out with. We're going to be making less money on each individual winner than we did if we were letting it run to full target. And some people struggle with this. However, if that one trade that lost made its way to the 70% of the target, then that would now become a break-even trade. So now we have 5 winners at 0.85%, which is less than the 1% we originally set out to achieve, which equals 4.25% profit. But that one trade that lost was now break even, so we didn't lose anything. So now on that same sample of data, we now have 4.25% profit rather than the 4% profit. So our overall profit has improved by going by scaling out. So as I say, this isn't like generic across the board. This doesn't work on every single strategy, but if we journal and we document this, we can actually see in real time which of our strategies this works out on, and we can actually see that scaling out can actually improve in some instances our overall profitability, even though it reduces our profitability on one individual trade. And again, the people that struggle with it are the ones that are very much profit focused, because they only look at the fact that they're making less money on any one individual trade, rather than being risk focused and seeing it as a bigger picture, reducing the risk overall, reducing the variance on the account, and actually having a positive impact overall on their bottom lines. Yes, Dan, this is being recorded. I believe the first two are up on the YouTube channel as well, on ActivTrades YouTube channel, so you can find the recordings there as well. Okay, we're now going to talk about blowing up an account. I'm not sure if anyone's done this so far, but blowing up an account is where you lose all the funds in your account with nothing left to be able to trade. The consequences, it can be catastrophic and even mean the end of the road for a lot of traders. If you blow up your account, some traders will just emotionally find it very difficult to come back to. And if you haven't got any more money to fund the new account, then you can't trade anymore. If you blow up your account with no additional funds to be able to refund an account, then you cease to be a trader and you lose all the opportunities that trading can offer. Unfortunately, in trading, without money, you cannot make money. When we're in the learning phase of our trading journey, or anything for that matter, and don't have all the necessary skill sets, knowledge, or risk management techniques, then we leave ourselves open to a greater probability of blowing up an account, because we're going to make mistakes. Making mistakes in trading costs money, and it can be a snowball effect. We don't have the emotional intelligence to manage our emotions, and therefore it gives us a bigger probability of blowing up an account. Now, unfortunately, many traders experience this. I actually know many successful traders, traders that have now been successful for many, many years, who have blown up multiple accounts. But for most, as I say, the psychological and emotional blow that they have initially can mean that they give up trading straight away. And if they funded the account with all of their money, then it ceases to be. So the traders that are successful are fortunate that they were able to refund. They worked hard, they had that resilience to keep going, to never give up, and to work on the mindset and work on the things to actually to come back from that and bounce back for that. But actually, for some people, it can have a knock-on effect in other aspects of life as well. So it can be really damaging. But hopefully, what we're going to show here as well is that if we can just manage risk, and what we've hopefully shown through the presentation as well is, if we can just manage our risk and learn to manage our risk, then actually blowing up your account becomes a lot less likely, if not almost improbable. So as mentioned in the previous slide, the consequences of blowing up an account are quite severe. If you blow up an account without the means to refund, as I mentioned before, you cease to be a trader. So how can you achieve the goals when you don't have the means to achieve them? It is the equivalent of your business going bankrupt. It will have a huge impact on you emotionally and may have knock-on effects in other aspects of your life. Could it potentially stop you from taking other risks in the future, stop you from achieving things in life that you deserve and desire? So you will have put a lot of hard work into learning how to trade, both in terms of time and energy. So please don't let it be for nothing by not managing risk, not learning and concentrating and focusing on how to manage your risk, and potentially blowing up your account. Now, all successful people suffer setbacks in their journey toward their end goals, but they will always dust themselves off, find a way to get where they want to be. Never allow yourself to lose the opportunity to be the best version of you. Even some of the most successful businessmen, like you know, Donald Trump has been bankrupt and then he became the president of the United States. Richard Branson has been bankrupt. Like, you know, Bill Gates, Steve Jobs, they didn't just make the perfect version of Windows and Apple and stuff like that. There was a lot of failures that built up into that. So what I'm trying to say here is, if it has happened to you, have the resilience, try and learn from the mistake, learn that, you know, we need to manage our risk, see it as a bit of a, it's going to take a little bit more time. Don't have that FOMO, look for that instant gratification, focus on what is important, and eventually I can assure you the rewards do come. As long as you focus on the foundations that are going to keep your account safe, then the opportunities are always there for you. So how to prevent yourself from blowing up an account. You need to create a well-structured and detailed trade plan. Again, we're going to cover this in another session. You need to set out all the principles, strategies, and risk parameters that you have. This trade plan should be built on a foundation of solid risk management strategies to allow for good account management. All your risk management strategies and the amount you should be the risk parameters should be detailed in your trade plan. You're going to need to develop the patience and discipline to follow and not deviate from your trade plans. You're going to need to build that mindset. You're going to need to build that emotional intelligence, the emotional IQ, to be able to manage your emotions. You're going to need to learn what emotions you struggle with, and put things in place in terms of how to mitigate them, making your trading decisions. Keep a detailed and up-to-date trade journal to allow constant review of your own trading performance. If you can consistently review your own trading performance, then you will always be able to remain dynamic and adjust. And as I said, you're going to need to work on that mindset to be able to accept losses and variance on your account. Now, all strategies will go through drawdown periods. You cannot allow these to affect your trading decisions. And there's things that we're going to talk about in the emotions session. I think that's more towards the end of the course, of the emotions that all traders go through. But we're also going to talk about a few strategies that we can put in place to really help mitigate those as well. So last couple of slides, and then we'll get into some questions as we're getting to sort of that 45-minute point. You must always trade with a stop in place and accept the loss on a trade if it hits that stop. The stop placement is there to protect your account. It is a good thing. You need to get into the habit of realizing it's a good thing if your stop is hit. You need to look at the positive thing, because if your stop is hit, then it stops you from blowing up your account. How many people have moved and moved and moved the stop to take a bigger loss? If you'd originally let your first stop hit, it would have been a good thing. And that's the way that you need to look at it. You demo trade. Open a demo account when in the learning phase to build the necessary skill sets for committing real money, excuse me, to the markets. Start with low leverage. Do not commit all your trading capital to an account. It's always good practice, but you should be at least until you're proven to have built the skill sets necessary to be consistent in your process. When you do start trading with live funds, you want to keep your stakes low and focus on the process and build up your leverage over time as your experience grows. So again, as an example, if you are just starting out trading and you've got £10,000 to commit to trading, fund an account with £2,000. Demonstrate the process. Once you've demonstrated the process, you're comfortable, go to £5,000, then £7,500, and then finally the £10,000. Just build it up gradually. And I think we spoke about that in the last session as well. Also, get help if you need it. So many traders have come to me when it's got too late. Reach out and speak to a coach or mentor or another trader or a trading partner or something. As soon as you start feeling more emotional in your trading, as soon as you start letting that risk slip away, don't let that go from one trading session into another trading session. If you notice it in one trading session, reach out to a coach, a mentor, a trading partner, something like that, because they can be the rational voice in your head to pull you back and track before it spirals out of control and gets too late for you to blow an account. Okay, and then finally, if you follow the advice in this session, it would be almost impossible to blow up an account. If you're demo trading, for one thing, you cannot lose any money because you're not putting real money on the line. And if you do keep leverage low and do not commit all of your funds to the account, you protect your capital and keep a lot of the opportunities available to you. Even if you fund an account with £2,500 and you've got £10,000, even if you blow up that original account, you have the means and the ability to refund an account, learn from your mistakes, and go again. So we're also going to quickly look at a way of compounding downwards and how that can actually protect your account as well. If you start with a £10,000 account and you risk 1% per trade for say, so that's £100 with no other risk management strategy in place, let's say you take 10 trades in a month and everyone loses, you'll take 10 months to lose 100 trades, which would blow up your account. Now, obviously, that's not going to happen either, but just as a generic example, if you lose 100 trades in a row, risking £100 because you started off with a 10 grand account, you're going to be bankrupt. You're going to blow up an account. Now, let's just say, for example, in the same example, you adjust your leverage at the end of each month to allow for any variance on your account. So in the same scenario, at the end of the first month, you're going to lose £1,000 because you're risking £100 per trade, and you're only going to have £9,000 left. But the following month, you're still going to risk 1% of your account, but that is now £90 per trade. So you're compounding down as well. If you follow the same process, after the same 10 months of consecutive losses, so 100 losses in a row, you're still going to have £3,500, an account of £3,500. So you're still going to have 35% of your original capital rather than 0%. Now, obviously, it's far from ideal scenario. Obviously, it's a very improbable scenario, but even in that scenario, even from this disastrous run, you know, your account is still alive and you still have the ability to realize your goals as well. So you can hopefully see that is like an absolute disastrous scenario that will never really likely happen. But, you know, it should show that even in a really bad scenario through a big drawdown period, if you're compounding downwards, if you're managing as a percentage of your account, if you're managing your risk appropriately, your downside is always protected. It's almost impossible to blow up that account by managing your risk sensibly, even in those drawdown periods. Right, guys, so that's the end of the presentation. I hope you found it useful. Probably a lot of it is fairly obvious, but hopefully by just putting it out there as well, it can open eyes, because it's not really spoken about. A lot of people focus on the profits because, you know, that's what sells trading courses, that's what gets people to follow them on Instagram, that's what, you know, feeds the FOMO of everyone. So they focus on the profits, but actually, to be successful in this game, we need to focus on the risk. That's going to create the long-term sustainability. So Ian, trading should not be treated as a gamble, but very difficult to maintain interest with a very small 1% or less wins. Okay, I've come across this a lot as well, Ian, but we're going to talk about compounding in another session as well, and it's just getting into, we need to build that mindset of, you know, setting a long-term plan, creating ourselves a roadmap, and see what it takes to get there. So unfortunately, like, if you cannot accept trading for small amounts with a longer term vision of getting to a larger account, and you want to increase your leverage, ultimately, basically, then you do become a gambler, because the emotions that are going to come with it, the irresponsible leveraging and stuff, is just going to mean a higher probability of you blowing up your account. So you're less likely to reach that end goal anyway. So it's trying to look at a bigger picture, and really seeing that, yes, although we may be making insignificant amounts at the moment, you know, if we stick to the right process, then eventually it will pay dividends. Again, it's not looking for that instant gratification. It's looking at the bigger picture to get to where we want to be, and the hard work then pays dividends. So is there any other questions around the risk? Any feedback on that as well? Anything that you would like to cover? Did you find it useful? Was it all fairly obvious? Have you seen that sort of thing before? It'd be good to get some feedback on that. So Lynn, as I say, I mean, look, I don't know where you are on your trading journey in terms of your experience. Look, 2% per trade. If you're a high frequency trader, I would say 2% is going to be way too much anyway. I personally recommend 1%, 2% if, like, you know, you don't trade too much, and you have some good experience in you can stick and you have some solid risk management strategies in place, then 2% is fine. But yeah, it's all about learning where you are in your experience, because obviously if you're inexperienced and you're trading at 2% and you go through a drawdown period of sort of 5 to 10 trades, then that can then have an emotional impact, knock-on effect as well. So without knowing your full experience in trading, I would probably advise 1%. But there are instances where you can go to sort of 2%, and that's okay. Is the risk element the size of the trade or how much you're prepared to lose? They should be one and the same things, Catherine. The size of any trade that you put on should only be the amount that you're emotionally prepared to lose as well. So again, if it's 1% of your account, you should be able to, you should be prepared to lose 1% of your account, basically, or you know, over a period of time, depending on your thing. But certainly from my experience, I'm prepared to lose 1% of my account on any one individual trade. I know it's not going to affect my long-term strategies or anything like that. So the size of the trade will always be the amount that I'm prepared to lose of my account, if that makes sense. If you're getting too emotional, then you need to either you're risking too much, in which case you need to work on your mindset to be able to accept that loss, or you need to reduce to a sensible, and that's either because you're over risking in terms of the size of your account, or you're over risking in terms of, excuse me, an emotional attachment to the money. If it's due to an emotional attachment for the money because you're still risking and leveraging a sensible amount, then you need to work on a mindset. And it's a mindset issue, not a risk issue. If you're over risking to try and make more money, and that leads to irresponsible leveraging, then you need to focus on improving your risk. Yeah, exactly that, Ian. Even though your own time is valuable, you need to see it as investing for the future, 100%. Like, I have, you know, my business, Keyzone Traders. I'm going to take this away from trading. I know Keyzone Traders is a trading education company, but setting up a business, you know, is very tough. You don't make money from day one when you set up your own business, but you put in probably the most work you're going to during the time of that business's life. So you work hard for future profits. You don't get paid. This is not a salary. This is not a salaried job. This is not your 9 to 5 job that society teaches you should have. So there are times that you have to put in the hard work to be able to reap the benefits later on. And you know, even if you think about it, in a salaried job, that's the same. You know, like when I very first started out in the city, I was on a very low wage, but I worked hard and I reaped the benefits later on in the career. So, and I probably worked harder in terms of actual graft when I was in those sort of like lower paid junior jobs. So yeah, 100%, that's 100% right. Even though you can't just look at it as though like I value my time at this, therefore I need to be making that. It's like, well, okay, I value my time at this. If I put in this amount of work, it's going to take me this long to get to that point. But you know what? If I carry on that process, you know, in X amount of months, years time, I'm actually going to be earning more than that amount. So it's going to offset later on, but you need to put the hard work in first. Can you use lot sizes to lower your risk on a trade? I'm not too sure what you mean by that, but yeah, you can reduce the number of lots that you trade so that you only risk smaller amounts. And I believe ActivTrades also allow for micro lots, which means that you can go to like 2 decimal points of a lot, which helps you manage your risk as well. And in that scenario, you can actually risk just as little as sort of like 5, 10, 20 pounds a trade if you've got access to micro lots, because you can like literally trade 0.01 lots, which is really beneficial. And once you're in a trade, you can actually close. You don't have to close out the whole trade. You can actually close out a portion of the trade to reduce the number of lots that you have open to reduce the risk, and that's that scaling out technique that we spoke about earlier on. Okay, so we're just approaching the top of the hour. So is there any other questions? If not, we can wrap that up. Excuse me, just seeing what we've got on for next week. Next week, we're going to cover execution. Yeah, next week we'll cover execution on how to set up and use demo accounts and trading simulators. So how we can set them up, and then how we can actually use those to improve as well. ActivTrade, I'm not too sure about, but if your trading platform doesn't allow you to scale out, then you need to input individual orders. So if you're going to scale, so basically, if you're going to say you trade one lot, you'll need to enter 2 half lot orders to scale out. Any platform that has MT4 will allow you to scale out, and I can actually cover that next week in the execution part of the session as well. Okay, guys. So if there's no other questions, we'll wrap it up there, and I look forward to seeing you all again next week. Thanks for taking the time again to come on this morning. I hope you found that useful. As I said, I think these are getting uploaded into the ActivTrades YouTube channel. I know the other 2 sessions are there. I saw them there the other day. So yeah, you can watch them back and watch the recordings on there as well. But yeah, I hope you're finding these sessions useful. Look forward to week 4 next week, which will be on execution. And yeah, hope you have a great week, and I'll speak to you all next week. Cheers, everyone.